Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, the European Union is set to impose a flat €2 fee on billions of small packages entering the bloc, primarily from China, in a move aimed at curbing a flood of low-cost imports and easing pressure on customs infrastructure. The proposal, unveiled by Trade Commissioner Maros Sefcovic, will impact popular online retailers such as Shein and Temu, which have capitalized on duty-free rules to ship goods directly to consumers. The new levy, expected to be included in a broader overhaul of customs regulations, would apply to an estimated 4.6 billion individual parcels delivered annually to EU households. A lower fee of €0.50 will be charged for bulk shipments sent to warehouses. Revenues from the measure would help cover customs control costs and contribute to the EU budget. Sefcovic emphasized that the handling charge is not a tax but, quote, compensation for the cost, end quote, of ensuring compliance with EU safety and quality standards. He warned the European Parliament that the volume of imports represents, quote, a completely new challenge, end quote, for regulators and customs officials, who are already facing mounting reports of unsafe or non-compliant goods on the market. More than 90% of small parcels imported into the EU originate from China. Chinese economy, of course, is highly dependent on large overseas markets for its exports, most notably the US and the EU. The measure follows a similar US initiative led by US President Donald Trump, who reinstated the elimination of the de minimis exemption on the 2nd of May. That exemption previously allowed shipments valued under $800 to enter the US without tariffs or formal customs clearance. Trump's administration cited concern over resource constraints and unfair competition from Chinese platforms. Temu, in response, halted direct shipments of low-cost goods to US consumers this month. The chair of the European Parliament's Internal Market Committee welcomed the EU plan, arguing it would incentivize sellers to return to using centralized warehouses, simplifying customs checks and improving regulatory oversight. With the EU following suit, this represents a hard hit to China's trade, the US and the EU representing China's biggest markets, and exports being China's last healthy growth engine. This is an area we've been following very closely on my other channel, China Update, and more could be on the way. Indeed, the proposal also complements a wider effort by the European Commission to eliminate its own de minimis exemption, which currently waives tariffs on goods under €150. The change would require online sellers to register for VAT, value-added tax, and assume importer responsibilities, increasing accountability and leveling the playing field for European businesses. Meanwhile, Chinese investment in Europe has rebounded for the first time in 7 years, climbing 47% to €10 billion in 2024, according to data from the Mercator Institute for China Studies and Rhodium Group. The surge is largely driven by greenfield investments in Hungary, where companies like CATL and BYD are building multi-billion euro battery and EV factories. Hungary, led by pro-China, or at least pro-China engagement Prime Minister Viktor Orban, now accounts for nearly a third of all Chinese investment in Europe. In contrast, the share held by traditional destinations like the UK, Germany and France has fallen sharply, reflecting a broader shift away from mergers and acquisitions toward new infrastructure projects. It also very much shows the carrot end of China's carrot and stick approach to the European Union, with Hungary being the beneficiary and many Western European capitals no doubt not being pleased by this. Now, despite this jump in 2024, the momentum may be fragile. The EU's investigation into subsidies at BYD's Hungary plant and recent delays in Shein's London IPO highlight the regulatory and political risks facing Chinese firms operating in Europe. As Brussels tightens trade and customs rules while weighing its strategic dependencies, both the volume and nature of China-EU economic ties are being recalibrated, likely heralding a more regulated and cautious era for cross-border commerce. Next up, we move to North America. A recent downgrade of US sovereign debt by Moody's Ratings has triggered potential ripple effects across global financial systems, with Hong Kong's $166 billion pension industry now facing regulatory restrictions on holding treasuries, raising concerns over forced selling and broader implications for US markets. Under Hong Kong law, pension funds operating within the city's mandatory provident fund (MPF) system are only allowed to invest more than than 10% of assets in treasuries if the United States maintains a top-tier AAA rating from at least one approved credit agency. After Moody's cut its ratings last week, only Japan's Rating and Investment Information Inc. R&I continues to rate the US at that level, preserving temporary eligibility. But any change by R&I could trigger mandatory reductions in US Treasury holdings. Similar constraints will also be seen around the world. MPF bond and mixed asset funds with potential exposure to treasuries total approximately half a trillion Hong Kong dollars, 62 billion US dollars. While this represents a small fraction of the global treasury market, the prospect of involuntary selling from one of Asia's largest retirement systems could heighten volatility in already fragile US bond markets, where investor sentiment is sensitive to credit signals and fiscal headlines. US long-dated bonds briefly sold off following news of the Hong Kong rules and Moody's downgrade, with the 30-year Treasury yield touching 4.95% and the 10-year yield climbing to 4.48%, reflecting investor unease over long-term fiscal stability. The Moody's move follows a 2023 downgrade by Fitch, leaving only one of Hong Kong's recognized rating agencies still giving the US a top rating. The Hong Kong Investment Funds Association has urged authorities to revise the MPF rules to exempt US Treasuries even if they are downgraded, a reflection of the broader financial community's view that Treasuries remain a fundamental global asset class, regardless of formal credit ratings. Most large international funds do not tie their Treasury allocations to rating thresholds. For Washington, the episode underscores the risks of rising deficits spilling into financial markets in unexpected ways, with US budget negotiations still continuous and long-term debt levels surging. Further credit downgrades, or even the threat of them, could introduce new systemic vulnerabilities. Though Hong Kong's regulators said they are monitoring the situation, the episode serves as a warning. America's fiscal reputation, once unquestionable, now carries a regulatory cost beyond its borders. But the fact that the Hong Kong side may be revising their rules to get around this issue suggests that while the credibility of US bonds is in question in the global market, there are not many viable alternatives. We're certainly living in interesting times. The world is going through tremendous change, and we're entering a period of danger, excitement, and opportunity. If you want to be on top of the most important developments as they happen, consider subscribing to Market Update, hit the bell notification icon, and you will be. 70% of regular viewers of Market Update are not subscribed. By hitting subscribe, you'll not only never miss an episode, but you also help this channel grow and be shown to new people, allowing me to continue doing this every day. And if you're getting some value from today's episode of Market Update, don't forget to hit the like button. And finally for today, Japan and South Korea are facing mounting economic pressure as the US escalates its tariff campaign under US President Donald Trump, sending ripples through Asia's export-driven economies and heightening the risk of recession. In Japan, according to Ministry of Finance data published today, Wednesday, export growth slowed sharply in April, rising just 2% from a year earlier, down from March's 4% pace. As car and steel shipments slumped, the figure missed expectations and was accompanied by a 2.2% decline in imports, with coal and crude oil leading the drop. Japan's trade balance swung into a deficit of 115.8 billion yen, 797 million US dollars, ending a 2-month streak of surpluses. The data marks a concerning turn for one of the world's largest economies, which already contracted in the first quarter and now faces the threat of a technical recession. Quote, "We are already seeing the impact of tariffs," end quote, said Yorichi Yodama of the Meiji Yasuda Research Institute, adding, quote, "It will become more pronounced in the future, and downward pressure on trade will intensify," end quote. By region, Japan's exports to the US dropped 1.8%, led by declines in cars and construction equipment. Shipments to China and Europe also fell. The yen's strength, averaging 147.7 per dollar in April, up 2.6% from a year earlier, further weighed on trade by cutting into the value of overseas earnings. April marked the first full month of Trump's expanded tariff regime, which now includes a 25% levy on Japanese cars and steel, and a baseline 10% tariff on all other goods, set to rise to 24% in July unless a deal is reached. Car exports to the US, which make up 29% of Japan's total exports, fell 4.8%, while steel exports plunged 29%. Major automakers such as Toyota and Honda have already warned of profit hits that could curb wage hikes at home, undermining the Bank of Japan's effort to build inflation through stronger pay growth. Meanwhile, South Korea is also feeling the sting of tariffs. Early May trade data, also published today, showed exports dropped 2.4% year-on-year, deepening April's adjusted 0.7% decline. Exports to the US fell sharply by 14.6%, while shipments to China were down 7.2%. Imports slid 2.5%, yielding a $300 million trade deficit. Auto-related goods bore the brunt. Car exports declined 6.3% and auto parts 10.7%. Steel shipments fell 12.1%. The sole bright spot was semiconductors, which rose 17.3%, driven by strong global demand for chips. South Korea is particularly vulnerable, with exports accounting for a significant portion of its GDP. Nearly half of the country's $70.8 billion in vehicle exports went to the US in 2024. The US has granted a temporary 90-day reprieve on 25% auto tariffs, reducing the rate to 10% while negotiations proceed. But data like these reinforces that Washington has tremendous leverage over both South Korea and Japan, and talks have stalled ahead of the June 3rd presidential election. The two main candidates are split on strategy. Front-runner Lee of the Democratic Party favors a cautious approach, while conservative rival Kim Moon-so has pledged to seek an early summit with Trump to resolve the impasse. Analysts warn that without an auto tariff compromise, South Korea has little incentive to rush a deal. Reflecting growth concerns, a state think tank recently slashed South Korea's 2025 growth forecast to just 0.8%. As both nations in East Asia pursue talks in Washington this week, the shadow of a broader global slowdown looms. Without breakthroughs soon, Asia's top exporters risk deeper scars from Washington's global trade reset. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Wednesday, and I will see you for a new episode tomorrow.